How's it going, investors? I'm Ari and welcome to my channel. Now, if you are brand new here, this channel is all about value and dividend investing. And initially I created it back in 2019 to show you all through how simple investing can be as long as you have a process and resilience in sticking with that process through the ups and the downs of the market swings. Now, I recently crushed a $100,000 goal, whereas my account is now sitting at $102,116.08. And I've honestly just decided to continue to create content of value for all of you in sharing macro market overviews, portfolio updates, as well as dividend stocks that are trading at or below their fair value. So of course that leads me right into today's video and giving a brief market overview of what's been happening in the stock market before breaking down 3 dividend stocks that I haven't mentioned a whole lot on my channel, but are in fact solid dividend investments. Now, just before we get going, if you could tap on that thumbs up button, as it greatly helps me out in growing this channel and getting the word out there. And most importantly, if you haven't already subscribed, I'd love for you to join me on this journey, so go ahead and do so now. Now, investors, let's go ahead and dive right in. So just this past week, we've seen the market tank to some lower lows that we honestly haven't seen since the beginning of August, which all came about after Powell's remarks on a more aggressive Federal Reserve. And as of Thursday and Friday this past week, the market began to rally even though the economic backdrop hasn't changed in the slightest. Now, this, my friends, is what I like to call real emotional investing.
You say it! Yeah, no, show you the money. Not show you! Show me the money! Show me the money! Yeah! Louder! Show me the money! That's it, brother, but you got to yell that shit! Show me the money! I need to feel you, Jerry! Show me the money! Jerry, you better yell! Show me the money!
Now, we had a shortened week and investors are of course anticipating lower inflationary readings from the CPI report due to be released tomorrow. While I also think investors are now baking in higher interest rates to come at the end of the month, I do foresee some more volatility as well when it comes to the Federal Reserve to actually make that big announcement. However, despite what's happening, you and I should remain focused on value and of course those longer term positions to ultimately prevail and fare far better off financially, which leads me to the very first dividend stock on the list today, that is Shaw Communications, ticker symbol SJR, which is actually a Canadian-based telecommunications company providing their customers with telephone, internet, and television services. Now, Shaw Communications was founded back in 1966 and within time became Canada's 4th largest telecom and cable company. As for their market capitalization, it's currently hovering around $12.83 billion. However, the communications sector overall has faced tremendous post-pandemic headwinds, including high inflation, macro pressures involving the decline of advertising dollars, shift away from cable and into streaming services, and just increased recessionary fears. Shaw Communications ultimately is of course caught in that crossfire and down on the year by roughly 13.78%, trading for $26 per share with a PE ratio coming in below 20 at 19.1, which is in fact in the ballpark of its Canadian telecom counterparts. What I thought was most interesting was exploring what hedge funds were currently doing when it came to Shaw Communications. Even hedge funds from Gotham Asset Management have been spending money and investing into the company, though a smaller lump sum. But we also have a group, Canyon Associates, investing over $163 million into Shaw Communications. And in regards to analysts, they too are optimistic about Shaw's growth, with a future target share price coming in at $29.95 per share. Now, given telecommunications companies are usually pretty safe and durable investments during economic uncertainty, I figured it was worth a look into and of course a potential add to an investor's portfolio, especially given their dividend yield is coming in at 3.67%. Next up, I want to go ahead and break down a real estate investment trust. Actually, both stocks I'm going to be discussing next are in fact REITs, given the sheer power of real estate investments during times of economic uncertainty and high inflation, aka the exact times that we're living in right now.
No, what are we hiding from?
With that said, the first REIT I feel is worth the honorable mention today is Medical Properties Trust, that's ticker symbol MPW, which, as many of you probably could already guess, is a REIT that invests into healthcare properties, anything from large-scale hospitals to smaller-scale healthcare facilities. Medical Properties Trust was founded back in 2003 and since then has grown a vast portfolio comprising of 447 properties spread across 32 different states within the United States, as well as an expansion of operations outside the US and into Australia, Colombia, Germany, Italy, Portugal, Spain, Switzerland, Finland, and the United Kingdom. So talk about safety through diversification. You are certainly getting it with Medical Properties Trust. With such a growth, of course, comes their sizable market capitalization coming in at $8.69 billion. However, the REIT does remain, in fact, down on the year by 36%, trading for a current share price of $14.63 per share, whereas once trading above $22 per share earlier this year. And while hedge funds have sold out of the position with Medical Properties Trust last quarter, hedge funds more recently have actually been buying right back into the position with over $15 million rather recently from various hedge funds. As for analyst forecasts, analysts are targeting a share price coming in at $18.25 per share. Now, as always, until it reaches the heights of that share price, Medical Properties Trust shareholders will also reap the benefits of a higher than average dividend yield coming in at a whopping 8.4%. And finally, a REIT within the incredibly high demand industry of data centers. We're going to be talking about Digital Realty Trust, ticker symbol DLR, which was founded back in 2001 and has flourished ever since, given just about everything since the early 2000s has become heavily reliant on data centers in order to actually operate. I mean, think about it. Everything from social media platforms to streaming services, cloud-based programs to countless other technologies now all require a data center to actually aggregate or store data. And as we continue to advance into the future, we're only going to continue to become more reliant on such facilities, which places Digital Realty Trust front and center for investors across the board, as it operates one of the largest portfolios of data centers with over 300 locations worldwide and in over 25 countries. And while larger companies like Google to Meta Platforms and Amazon all operate their own data centers, they still partner with Digital Realty Trust while working with all companies unable to actually afford their own data centers. So we're talking about a serious moat around Digital Realty Trust, and ultimately this kingpin worth of a REIT is hovering around a $35.05 billion market capitalization. But given the volatility in the market, primarily around the fears of an aggressive Federal Reserve hiking interest rates, Digital Realty Trust has taken a hit and is down on the year by roughly 30%, trading for $122.19 per share, where it was once trading for over $170 per share. Now, this REIT is within its 52-week low range, and it's looking extremely attractive to investors, as we can see hedge funds have been loading up on shares, with the most recent $79 million investment coming in from AEW Capital Management to Ray Dalio's $22 million investment, as well as the bullish blogger sentiment and favorability across the board with the retail investor as they continue to buy more shares worth of Digital Realty Trust. Now, analysts are also forecasting growth, with the target share price coming in at $152.57 per share. But if an investor is, with this one, a long-term investor, which they should be given the direction of the future, a shareholder of Digital Realty Trust is also going to be rewarded with a solid dividend coming in at a 3.99 dividend yield, which is likely to raise over time, as Digital Realty Trust has raised its dividend for the 17th consecutive year this year and seems to be gunning for the Dividend Aristocrat title. Now, investors, there you have it. From Shaw Communications to Medical Properties Trust and Digital Realty Trust, the three dividend stocks that you may want to consider adding to your portfolio, or at least to your watch list, as we trudge through these uncertain, volatile economic times. Now, just before we actually close out for the day, I would certainly love to know your thoughts on these dividend stocks, if they're within your portfolio, or if you're now thinking about investing into any of these opportunities. Go ahead and drop all those comments down below. And just keep in mind that I'm not a financial advisor, so always do your own due diligence prior to moving forward with any investment moves. But if you wish to make any move at all, let it be tapping on that thumbs up button to help me grow this channel and show your support. And of course, if you haven't already joined me on the journey, I want you to go ahead and subscribe as well. I would certainly love to have you on this journey with me. Now, until next time, I will see you all in the next video.